All right, we'll go ahead and get started. My name is Nate Zeller. I'm the Chief Investment Strategist here, Secured Retirement. Thank you all for coming. I see many familiar faces, which is good today. We've done a big pivot here. We're originally slated to talk about taxes, always exciting topic, but given the geopolitical events in the world, we thought it would be good to talk about this. There's a lot of concern in the market, and I'd like this to be very interactive, so I'm open to questions, comments. I'm going to talk a little bit about the situation going on. I'm not a political scientist by any means. I watch a lot of stuff on news and read the papers and sometimes think that I am. And I'm married to a political scientist who now works in healthcare, but really, so we're going to talk about that, but primarily I want to focus on the investment implications, also talk about what history says about such events. So, need to start, first of all, and give our disclaimer. These opinions are likely to change without notice. I will be talking about some investment strategies today. Some general terms. The reason I bring this up is shouldn't be construed as individual investment advice. If you'd like to talk about your situation, glad to do so afterwards or later on this week, whenever, too. But if I say something, I don't mean for you to go out and buy it necessarily or sell something. So that's our usual disclaimers. I wonder if this works now. No. Okay. So first of all, I wanted to show everybody a map of Ukraine. Maybe a lot of you are aware of where it is. As I was looking into this a little bit, I'm not real sure. I mean, if you ask me where any state in the country is, I can pinpoint to it. Most of the countries in Western Europe, Eastern Europe, I was unfamiliar with, so I wanted to bring up a map, show where it is. Obviously right next to Russia, below Belarus, Poland, the old Eastern Bloc countries. Now remember, most of these are all NATO now, so we're tied to them, associated with them, with a few exceptions. This is a little larger map of Ukraine. You can tell this is an older map because they spell Kiev the old way. They spell Odessa the old way. I guess it's something to do with the translations. Odessa is now spelled with one S. I don't think they really changed the city names. But just to give you an idea, now this is just going off on its own. Ukraine is the second largest country in Europe by size, has a population of about 41 million, give or take. It fluctuates. There's a lot of farmland in Ukraine. It's known as the breadbasket of the world because it exports a lot of grain, especially to Northern Africa, the Middle East, and other parts of Europe. It used to be part of the Soviet Union. And it's had a partnership with NATO since 1994. The reason I mention this is there's a lot of reports that say Putin invaded because he doesn't want Ukraine to be part of NATO, as if it's a new development that's just happened in the last 6 months. They've been having these talks for years and years, so this isn't anything too new. When I was working on this over the weekend, the plan was for them to apply for EU membership, European Union membership, sometime in 2024 and join in the 2030s. They officially applied this morning, or I guess tonight, to be accurate time zone wise. So they're trying to join the EU immediately. A little bit of a timeline. Again, some of this is maybe repetitive for, I'm guessing all of you have been watching the news lately. The Russian troops have been amassing near the Ukraine border since the early part of 2021, so for about a year now. This isn't a troop buildup that's just occurred the last couple months. This has been going on for some time. There's also, some of the troops came from Belarus to the north, and it sounds like Belarus is going to join in the attack in coming days. Belarus obviously is sympathetic to the Russians. The troop strength is about 190,000. Current estimates are a third to maybe a half have entered Ukraine, so a lot of the Russian troops are still built up at the border. Russia's denied, this is like the least surprise attack of all time, because Russia's said they're not going to attack for a whole year, and lo and behold they did, which nobody doubted. And thus far there's no direct military action from other countries, but there's been a lot of aid to Ukraine. At this point, the entire Western world has joined in. Yeah. And then there's been sanctions placed upon Russia by most Western countries. I thought it was interesting, again this morning, Switzerland, who's always been neutral, came out and placed sanctions. They shut down their banking to Russia. It's the first time in history they've done that, from my understanding. And some of these sanctions, too, aren't necessarily targeted at the country, but at Putin himself and some of his closest aides, some of the very wealthy people in Russia. really the concerns here, if you step back for a second and think about Ukraine, the U.S., we don't trade much with Ukraine. I mean, so this attack on its own really doesn't impact us. And I don't mean to sound heartless. Our thoughts are obviously with the people of Ukraine. It's a very dire situation over there. I mean, people leaving the country, I do have my sympathies. But they don't trade much with the U.S., so this attack on its own shouldn't impact us much. What could happen, though, not to scare everyone, is what happens next. There's a lot of rumors that Putin's completely lost his mind. He's nuts. He's talked about nuclear weapons now over the weekend, which has a lot of people frightened, rightfully so. So how far will he go if he is able to capture Ukraine? Will he move on? And if, again, getting back to the map, those countries surrounding it are NATO countries, which would draw Western Europe and the U.S. into war and, in essence, create World War III. So that is probably the biggest concern. It seems unlikely at this time, but it's, who knows. But I think the biggest question is what impact will this have on world markets and the stock markets. The Russian market is closed today because it's basically non-functioning at this point. With all the sanctions, the ruble, which is the currency in Russia, it's lost about 75% of its value against the dollar over the last few weeks. Today alone, it was down about 30%. There's lines of people in Russia lining up to get their money out of ATMs. There's huge bank runs. Their economy's a mess at this point. And this war, from again my understanding, I'm not there. It's hard to say, and you can't believe everything you see on TV or the internet. But this invasion seems very unpopular within Russia and the Russian people themselves, and even within Putin's inner circle, which is kind of scary, because he knows that if he's not successful at this, he'll probably be kicked out of power. And the problem with that is that it creates more resolve on his part to go further, do more damage and more harm, which is certainly not what we want. So a little bit of history, getting into the investment side of this now and the impact. Looking back at some of the past geopolitical events and what occurred, you can see that there were sell-offs, but they're generally very short-lived. And then it didn't take long for them to recover. This, I do have to credit JP Morgan Asset Management. I borrowed this from them. But if you look, the average days of sell-off is 12 days. It says average days recover 137, but if you look back at the very top item here, it's the Israeli-Arab War and the oil embargo in 1973. Took 1,400 days. Conditions were a little different back then. So that's really skewed, but if you look at the rest of these, the time to recovery is measured in a couple of weeks at most. And then the size of the sell-off, too, in most cases, really wasn't that large. We can go back further beyond this, too. Look at Pearl Harbor is another example where there was a sell-off. The sell-off then wasn't as large as you would have thought. I mean, that was an attack on American soil. The market dropped 10 to 15%, give or take, and it recovered within a couple months. Actually, the markets did quite well during World War II here in the U.S. So I guess what I'm trying to say here is a lot of these geopolitical events really don't rattle the markets that much. It's a real knee-jerk reaction, and generally speaking, the markets recover quite quickly. What you need to think about, too, is what else is going on in the world. I think of the 9/11 attacks, which came at a very inopportune time with our economy. That was the dot-com bust. Our economy was fairly fragile at the time, which the terrorists probably knew. And so a lot of what happened then could be attributed to what was going on with our markets and economy at that time, and not maybe as much of a result of the attacks themselves. A couple of quick definitions, too. Everybody talks about a market correction. That's a decline of at least 10% is the definition. We've seen 24 of those since 1974. They're perfectly natural. They happen all the time. Markets just get a little ahead of themselves. They pull back a bit. Really not a big deal. There's been declines of at least 20% 6 times since 1974, and those are called bear markets. Each of those can be associated with a major event. And generally, these are economic events. The dot-com burst, the Great Recession, the housing meltdown, whatever you want to call it, real estate meltdown. COVID, the pandemic a couple years ago, there was a bear market. That bear market lasted all of, 2 weeks or 3 weeks? It was extremely short-lived. Going back further, 1980, where we had a large rise in interest rates, huge increase in energy prices and stagflation. We're going to talk a little bit more about that here in a second. So year to date, just kind of where we're at, and I put a bunch of numbers up here. It was interesting to see what happened in the market last week. So the market was already trading quite a bit lower prior to the invasion last week. On the 23rd, which was last Wednesday, you can see the S&P 500 was down 11%, the NASDAQ was down 16%. It's so far been their lowest points of the year, so they were in correction territory. The Dow itself was not quite, it was only down about 9%. There was the invasion. If any of you sit in front of the computer and watch the markets all day long, like I do, yeah, I know I need to get a hobby, or I guess it is my job though. The markets dropped pretty dramatically in the morning of the 24th, which was Thursday. But then they rebounded. When sanctions were announced, there was a lot of hope, a lot of optimism for a more peaceful resolution. And then on Friday, which was the 25th, I know these are all out of order, there was a lot of optimism too that there was going to be talks held between the two sides, and again, hoping for a peaceful resolution. If you start to look at some of these numbers, so from the lows on Thursday to the recovery on Friday in the NASDAQ, I mean, it gained 7%. That's a huge move just in one day. The S&P 500 went from being down about 13.5% to 8%. We're talking 5.5% over, we'll call it a day and a half's worth of time. In normal times, they always say buy the rumor and sell the news, which we see quite often. Here it seems to be sell the rumor and buy the invasion, which doesn't really seem to make a lot of sense. So we have all this going on, and you know, so what happened? What caused the whipsaw? The biggest one is probably the proposed sanctions. Everybody was optimistic. We saw this. Well, through the weekend there was the sanctions. There was obviously Putin, with his nuclear intentions, or his, I don't know, they think it's a veiled threat at this point. Hopefully it is. That's it. So the market was trading lower, and then the two sides came together to talk, and so the market started to trade higher. Then they said the talks broke up. There was really not a lot of progress made, but they still are agreeing to continue to talk. But at that point, then the markets dropped. I don't know where they are right now. That was as of an hour or so ago. The other one, and this is the reasoning being given by a lot, is that the markets were already oversold. Like I showed you before, the markets were already down 10, 12, in the NASDAQ's case, 16% year to date. And a lot of people just thought that it's gone too far. And if you look at what's going on here in the US, so like I said before, in the Ukraine, that doesn't directly affect a lot of what's going on here. What we need to be concerned about in the US market are the usual earnings, corporate profits. We're getting towards the end of this earnings season, but profits have been good and growing, continue to grow. We should be worried about inflation. We should be worried about interest rates. But also on the positive side too, is it seems like we're maybe getting through the pandemic. Finally, I use maybe because I think a year ago we said, yeah, it looks good, and then all the variants, and it's gone the wrong direction. So there's, focusing on the fundamentals of the US market, things look pretty good. We very well could have been oversold from where we were. And also the prospect of less aggressive Federal Reserve action. The Federal Reserve meets here in a few weeks, middle of March, and they were, with all the inflation going on, a lot of people anticipated a 0.5 point, 50 basis point interest rate hike. Now with this, the odds are, they're saying about 80% chance that it's only 0.25%, which the market views very favorable. The market doesn't like higher interest rates because they think it's a hindrance to growth. Speaking of stock valuations, this is a number a lot of people focus on, is the price to earnings ratio. This has come down. Everybody keeps saying that the market's overvalued. There's a lot of naysayers for the last couple of years saying we're going to see a 2000 style meltdown because the market's so overvalued. And with the pullback, the price to earnings has come down considerably. And I think more importantly than the trailing piece, that's looking backwards. How does the price compare today to the earnings over the past year? That's investing through the rear view mirror. I like to look through the windshield, look forward. How do things look going forward? This is based on forward-looking estimates. What's the forward price to earnings look like? And that's 19.2. The last 5 years average is 18.6. And if you go back 25 years, it's 16.5. Over the last 5, 10 years, it's slowly been creeping up, as you can see. But anyhow, we're getting much closer to our long-term averages. And there's two sides of this equation. There's the stock price and there's the earnings, and earnings are continuing to grow. So even if these stock prices stay where they are, or they can grow, but if earnings grow faster, this ratio is going to come down even more. So I guess the bottom line here is I think stocks are pretty fairly valued at this point. There's a few exceptions, a few sectors. Getting back now really to the risks of what's going on in Ukraine in that situation, like I mentioned previously, I mean, this Russian aggression continues and gets worse. Like I said, it depends on what Putin's intentions are. I think he's acting very much alone in this case. And how does China view this? There's concern that if Russia's successful, they may see that, okay, nobody's going to stop us, so we can go, and obviously Taiwan is their target. There's concerns there because Taiwan produces a very large number of chips. We've all heard about chip shortages affecting costs of cars and a whole lot of different things. So that's another concern. Coming out of all this, though, like I said, the geopolitical events themselves generally don't move the U.S. markets that much and aren't as large of a concern. What I do see as being the biggest risk coming out of this is inflation in the form of higher energy prices. Russia is a huge exporter of oil and natural gas. I think they're second largest exporter of oil and third largest exporter of natural gas in the world. They supply about 50% of Europe's energy. And with a lot of their banking being shut down, they're no longer able to trade in oil and gas. Oil trades in US dollars through banks. And since they've been excluded from that, they cannot trade their oil as readily as they could prior to today. And with such a large supply, that obviously has to be made up somewhere else. The U.S., we have ours. We've had our own supply issues over the last couple of years. And so we see higher energy prices, which then has a downstream impact. All these goods that we're buying have to be transported somewhere. So it's not just the price that we're paying at the pump or the natural gas prices that we're paying to heat our homes. Also food, like I mentioned, Ukraine is considered to be the breadbasket of the world. It's more the Middle East, Eastern Europe. If they're not able to transport their food, and that's the thing, they're still able to grow their crops. Not like their crops disappeared overnight, but they're not able to transport them. All the ports, if we go back to the map, all their ports on the Black Sea have been shut down effectively. So at this time, and it's only been a few days, there's no way for them to get their goods out of the country. And so these other countries are going to be looking for their wheat, barley, other places, obviously pushing prices up, and we see that in commodities prices today. Other risks too, and again, getting back is, the one takeaway here today is don't be as concerned about the geopolitical risks, but more focus on the fundamentals of the market. And we should be more concerned with inflation, higher interest rates, and continued volatility in the market. One thing I wanted to bring up is portfolio protection. The number of calls that came in last Thursday, and I don't mean to make light of the situation, but I've been in this business for almost 25 years, been through .com, Great Reset, all these ups and downs, is we always get the calls when the market's down and say, hey, what can I do to protect my portfolio? It's too late at that point. You want to prepare for these things ahead of time. I always think, of an umbrella. I think back a few years ago, my wife and I went to New York City just this weekend. We've been there for work separately, but never together. And we had this big plan to go out to Central Park one day and just spend this beautiful day there. Well, it just downpoured rain, and we got caught out in the middle of it. And we didn't have an umbrella, so we were wet. My wife's like, we need to buy an umbrella. So we did. We were already soaked. It didn't make any difference at that point. And so the same goes for a portfolio too. So it's been a real gut check for people, I think, with this volatility. The market's been going up last couple of years. And so this volatility has made people nervous. And if that's the case, what we ought to do is sit down, take a look at your portfolio, and protect it when times are good. This being said, it's not that the market can't drop further from where it is. And really what it comes down to, especially for retirees, have multiple sources of income, manage your risk tolerance, diversify your assets if you think that you're too aggressive. And also, consider non-traditional strategies. We've talked about some of these with a lot of you too, making sure that your income plan is in place. Bonds are probably not the best place to be right now. We did see some movement in the bond market last week with the flight to safety, of course. But there's some of the structured products that we work with where they provide the buffer on the downside and then the upside return. So getting back to, there's also opportunity, there's a lot of opportunities in the market right now. These geopolitical events that are a real knee-jerk reaction push the market down for a short period of time. It provides buying opportunities quite frequently, especially when looked out on a longer-term basis. And so with inflation, the hard assets have been a good place. Now gold, the last few days has done well. Again, this flight to safety, but over the last year or so has not done quite as well. But real estate, a lot of the commodities do well. Prepare for higher energy prices. I would not necessarily go out and buy oil and gas stocks right now, though. Again, there's this knee-jerk reaction that's pushed oil prices up quite a bit higher. And I'm not smart enough to figure out, okay, let's take out the Russian supply. What does it do to the rest of the supply, and where does that push prices? But I did hear a presentation this morning that somebody thought that number is probably about $120 a barrel. It could go higher. So right now we're sitting at 100, and all these energy stocks have been bid up. So it's already probably factored that in. So I don't know if there's a lot of opportunity left there unless the energy situation gets much, much worse than where we think it's probably going to go. And then you can take advantage of higher interest rates, obviously, for people saving money. Those interest rates will be higher, or look at some financial stocks. Banks profit off higher interest rates, higher net interest margin. With the market pullback, many sectors are now reasonably priced. Tech still looks expensive, but your energy is pretty close to longer-term averages. Materials looks good. Healthcare, for example. I still think growth and innovation continue to drive the economy over the next few years. Getting away from the geopolitical events, what's going to really drive things, into the future, 5-10 years down the road. And I still think there's a lot of growth there. Small cap value looks cheap or inexpensive. And then there's also opportunities in some emerging markets. Some are very scary. Obviously, you probably don't want to be in the Russian market right now. Some of the Eastern European markets are probably not the place to be, but Brazil, they have a lot of energy, materials, commodities output. India has a very large growing middle class, large population growth that's modernizing, so there's certainly opportunities there as well. Then the certain sectors that tend to perform well in inflationary environment, see a lot of familiar faces from my presentation last month. This is the same slide that I had back then, and things really haven't changed. If anything, inflation situation probably looks worse now than it did a few weeks back. And again, like I said at the beginning with the disclaimer, don't go out and buy all these things today just because I'm flashing this up here. One thing I like to do sometimes, and for anybody that's going to watch, I guess, which is going to be the recording now, it's maybe hard to see, is right now with the market pulling back. There's a lot of stocks that have come down quite a bit. And I hear from people, oh, I'm going to buy this. It's 70% off its highs. It has to return to where it was. And I pull out these charts, and for some of you, you're like, well, I knew this already. But for a lot of people, it seems to be real eye-opening. This is a stock, and this is a 30-year chart. I don't have it down there. It's also a logarithmic scale over there, but that doesn't make much difference. This is 2000, 2001. This stock is still not trading at the same level that it was back then. Anybody know what this is?
Cisco?
Close, good guess, very good guess. Close. It's Intel. And Cisco's the same story. Then there's a lot of 2001 stocks that are no longer around, and the reason I bring this up, again, some of these tech stocks have just been beat up, and people are like, hey, it's a great buying opportunity. I would really pay attention to those companies making money. Your Googles and companies like that have done well, continue to make money, are a good place to be. Here's another one as well. This one's a little different. It took 2001, it took about 15 years for this one to get back to where it was. And since then, it's really done well. And so these are ones that have done well, very solid companies that did eventually recover, but not all companies. There's a number of other companies I could flash up here too that have not come anywhere close to the levels they're trading back in 2001, but are still around. Many of you probably have not heard of them. There's a lot of other companies too that simply didn't survive or maybe got bought out. So I guess in summary, it's easy for me to stand up here and say this, but do not let short-term geopolitical events drive long-term decision making. Step back and take a look at the big picture, focus on the market fundamentals and what's going on, corporate earnings, inflation, interest rates. Consumer remains healthy, I'll throw that out there as well. Consumer spending is about 2/3 of our GDP. The consumer spending looks good. These earnings reports after the holiday season are very strong. Make sure that you're comfortable with your risk tolerance. You know, after the market drops, it's too late. So this has been a real good, like I said, wake-up call or gut check for some people. And it's difficult, too, when the market's going up. You have this fear of missing out or whatever you want to call it. But that's the time to look at buying insurance or being a little more conservative if you need to be. You don't want to lose sleep at night or have an uneasy feeling about your investment portfolio. We do remain bullish on the equity markets. I still think there's a high probability we end the year higher with positive returns this year, but I think it'll probably be more modest than previous couple of years. This is what I've been saying the last couple of months, and that certainly has not changed because the fundamentals of the market remain intact. Watch inflation. I think that's the biggest risk to the market going forward, especially coming out of the Ukraine situation. Again, there's non-traditional investment strategies for portfolio protection. Take a look at what you're invested in. Make sure that your income's keeping up with that. Make sure your savings are keeping up with that. You know, it gets into real returns. You know, and I'll ask people, would you rather have a 7% return with 2% inflation, or a 10% return with 5% inflation? It's the same because it's all about maintaining spending purchasing power. And like I said too, there's ways to take advantage of it too. If it does continue, look at some of these. They've been out of favor sectors for years, materials, even energy to a certain extent.
Small cap value, they've done pretty good over the last 18 months, have they not? You say they're still pretty good.
Well, from a valuation, so you look at their price to earnings compared to the longer term, yes, they do look good. The small cap stocks have struggled. Minus small cap growth really took off last year, and it's probably the one area that's done the worst recently. And the reason why is a lot of those small cap growth companies are new, they're starting out, they don't have positive earnings. And so people are moving away from those. If you look at small cap value, the other thing is these are small companies, they generally don't have a lot of exposure to overseas, which with everything going on right now is probably all right. And so these are companies that are smaller, so their suppliers and their buyers are domestic companies. Yeah, so I think that they could do all right in the next year to 18 months. Provide a little more safety too.
Talk a little more about your non-traditionals.
Yeah, so the question there was about non-traditional investment strategies. Like I said, traditionally speaking, people would go out and buy a 60-40 stock bond portfolio, with the thought being that stocks will go up and your bonds will provide protection if the stock market drops, because there will be a flight to safety with bonds. The problem with that is bond prices and bond yields it's the inverse, the teeter-totter relationship. And bond yields have been dropping for 40 years. So they're finally, we're at about zero. They've actually come up quite a bit this year, relatively speaking, but still remain low. And so the fixed income, the bonds are not able to provide the protection that they have. If you look at the first, we'll call it month, 6 weeks of this year, stock prices fell and bond prices fell because yields were going up. Now, bond prices didn't fall as much as stock prices. So yes, on a relative basis, they were a little more conservative, less volatile, but they didn't provide the protection that we've seen over the last, really, we'll call it 25, 30 years. So now with non-traditional investment strategies, there's other types of alternative investments out there. We look at bond alternatives. And like I mentioned too, I don't want to make this sound like some sort of product push. We look at these structured notes, the buffered type notes I think we've talked to a lot of you about, where they provide a certain level of buffer on the downside. And so you're protected if the market drops so much. And then there's upside, but maybe it's capped at a certain level. So there's a lot of, these are newer strategies. Some of these are a little more complex, but I would look at things like this for protection versus just looking strictly at bonds and fixed income, like traditionally was done, I guess, forever and ever, until maybe the last 10 years or so. Yeah, to be honest, I'm not real familiar with those. I'm aware of like the Philadelphia Stock Exchange, and generally they take overflow from the New York, historically speaking. The problem that you get into with some of the smaller companies, too, is they are more risky. They maybe don't have as strong of balance sheets, or they're not as well established as other companies. And then you get into the liquidity, too. And we saw this in 2008, where things started to drop, and people are like, I want to sell, and they couldn't because there's no buyers. If you think about a stock, you have to have, or a bond, any asset for that reason, a house, real estate, you have to have a willing buyer, willing seller. In 2008, there were not willing buyers. So people went to sell and they couldn't. And I think you'll see a lot more of that when it comes to thinly traded stocks. Or maybe you can sell, but at a price much less than what you're expecting to get. Kurt, do you have a question?
Yeah, how many interest rate hikes would you expect, and how much this year? And part two, would you expect a U.S. recession in 2023?
Great question. So the question was, how many interest rate hikes do we expect this year? Do we expect a recession in 2023? A lot of investment houses right now are predicting 7 interest rate hikes this year, which pretty much means that the Fed would raise rates by at least a quarter point at every one of their meetings from now until the rest of the year. I think that they're going to go a little slower, kind of see what happens. Obviously, the geopolitical events factor into this. They want to see how much of an impact. The Fed action, it doesn't have an impact right away. It only takes about 6 months for it to work through. So my guess is that there's probably closer to 4 or 5 this year, barring any unforeseen event. As far as a recession next year, that's the million-dollar question. I mean, that would take slowing growth. I think that if we were to see a huge spike in energy prices, it would push us into a recession. Without that happening, probably not. That's my current guess. One of my concerns, too, is I was talking about bear markets and what's happened. 1980 is a great case study for this, I think. There was a huge recession back then. And look around this room, a lot of you probably remember it better than I do. I won't tell you what I was doing in 1980, but it's a great first day of kindergarten. Just told you all my age, I think. But what happened is there was the revolution in Iran that pushed up oil prices dramatically. There already was a large amount of inflation in the U.S. Paul Volcker at the Fed came in and said, we need to hike interest rates, which interest rates, again, they hindered growth, but he had no other choice. Inflation was so bad in this country that they had to hike interest rates quite a bit. So that, coupled with the price spike in energy, pushed the country into a very deep, very prolonged recession at the time. And I think that that very well could happen here. The only difference is at the time unemployment was very high in the U.S. Right now unemployment is very low. There's a lot of job openings, so people are continuing to work. But that brings on another thing. I mean, economics and the markets are, it's like me watching YouTube at night. Oh, this is a great video. Let's go down the rabbit hole and watch more and more. So the other effect with this too is we have a wage spiral going on right now where people want higher wages. So then employers are like, okay, in order to retain our employees, we need to pay you more. But in order to afford these pay raises, we need to raise prices for our goods or services that we're selling. And so then people are like, well, I'm a consumer. In order to afford these higher prices, I need a wage hike. And you can see how this is spiraling. So we're seeing some of that right now, leading to higher inflation, but unemployment's very low. So that's what makes me think that we probably will not see a recession. That's my guess. We'll see. This is being recorded, so sit down a year from now and see if I knew what I'm talking about.
If the pipelines were reopened and we became energy independent again, how would that affect the market?
I think that'd be fantastic. I think that'd be great if they opened the pipelines, if they permitted the drilling on federal lands that they've shut down the last couple of years. The U.S. last few years has had to export a lot of energy from Russia. That's probably not going to be available going forward. So we are apt to get a little squeeze, but if we're truly energy independent like we were a couple of years ago, I think that would have a huge effect. We'd probably see a normalization of energy prices, especially oil prices. And yeah, so hopefully that does happen. Yes, ma'am.
When you, going back to a previous question or topic, when you talk about the non-traditional investment strategies, might that include something like insurance annuities?
Yes, it is. So an annuity would be like a fixed index annuity, would be a alternative for fixed income. Because if you think about it, it provides income, or it can down the road, not necessarily. It's tied into an index, and it's the one thing that we can say we're guaranteed not to lose money on. So yeah, that's very much so a non-traditional alternative that can be used in lieu of fixed income. And we've done that a number of times, and it's been very successful.
Just wondering, electric vehicles, do you see that would be a big push now with energy prices in the US to really push on the electric vehicles?
That's what they're saying. Yeah, so there's two parts. You have to make the electricity somehow, so we've seen coal prices move up quite a bit the last few months. And then it takes a while, but that is the thought, that there's going to be more of a push into renewable alternative energy sources in coming months to get away from the fossil fuels, but it's a slow process to build the infrastructure and get there and make it economical as well. It was interesting, Chevron, a huge oil major, bought a renewable energy company over the weekend, a big one, I guess, too. I'm not familiar with it, so I think they see it going that way. Well, thank you all for coming. Appreciate you coming out. Looks like spring's maybe finally in the air, and if any of you have questions, don't hesitate to give us a call. Till tomorrow, when everything changes. Oh, I apologize, I have to put in the plug. Andy, aren't you next week, social media?
Hi, everybody. Yeah, so next week it's a market huddle, and I'm going to actually host it. It's on social media, but it's about how to keep your account safe. If you ever use your social media to pass through to your financial accounts or anything, it can be compromised, and it can be bigger than just your Facebook being compromised. The following week after that, Joe Lucy will be on with Andy Ives. So if you've ever had Andy Ives or watched our market huddle, that's on RMDs specifically, and the age 72. So if you're not 72 yet, it's a pretty big birthday, and RMDs is an impact to that. So that will be on March 14th. And then on March 21st, Nate will be back joining us, as the Federal Reserve report will be out on the 15th through the 17th, and I think you're going to help keep the conversations going about inflation. And then next month, Lunch and Learn, we're still figuring out that after shuffling around a few things. So we hope to see you back here. Thank you for your patience.